So we are doing this paper of October-November 2024. It is A-level accounting. Cost accounting. Cost accounting will come in paper 41, 42. You basically have two questions to answer in 1 hour. So you should remember this, that you have 30 minutes to answer one question. Okay. So the first question that had come in October, November 2024 was standard costing. And second that came was investment appraisal. So we are starting with the first question. As you could see over here, the first question is a theory question. So when there is a theory question, you actually do not need to go and read the question. You can just answer. So can you tell me the first part, 4 marks, two reasons why a business may conduct variance analysis? Can you tell me what is variance analysis?
It's the difference between the standard budget and the actual budget.
I don't know what's a standard budget.
Standard budget is like all of your estimated price and quantity
So when you talk
rate
about the
and stuff.
standard budget, you have two types of standard budget.
Yeah, one is master budget and one is flex.
One is master budget and one is flexed budget. What is a master budget?
Master budget is standard rate with standard quantity. It's all estimated. And flex is standard rate with actual quantity.
Standard rate into actual quantity. So when you compare your flexed budget with your actual budget is
Mm,
actual rate into actual quantity. And if there is any difference, you get a variance and you do a variance analysis.
yeah.
So why does a business conduct variance analysis? You need 2 points.
Because they want to set their budgets.
Budget is set. I'm doing analysis. I'm doing variance analysis. Why do I do the variance
They,
analysis?
because they want to find
So you basically
and compare.
compare the actual results and your budget.
Mm,
That means you compare your actual budget with your flexed budget. Why you are doing this? So that you can take actions for remedy and improvement. So in variance analysis, you are comparing your
okay.
actual with the flexed, okay, so that you can take actions for remedy and
Mm,
improvement. 1 mark for saying comparison and 1 mark for reasoning it out. Also, you do this
okay.
variance analysis so that you can measure the performance of your managers. When you're measuring the performance of your managers, this helps you to analyze whether you want that manager, and if he is doing better work, you will have favorable variances, so you will determine their bonus eligibility. Okay.
Okay.
Okay. Now, what is a fixed overhead capacity variance? You have known
Um,
about fixed overhead variances. Fixed overhead, we had two variances, right?
yeah, fixed overhead volume variance and fixed overhead expenditure variance.
Fixed overhead volume variance is what? Standard quantity
Standard quantity over,
or actual
I mean,
production
for actual production.
minus actual quantity
For
for
actual
actual
production.
production into standard rate. But in fixed overheads, our standard rate was what? Overhead
OAR.
absorption rate. How do you get the OAR?
Budgeted overheads over budgeted activity level.
So you get the over OAR by budgeted overheads over the budgeted activity level. Okay, fine. What do I mean by standard quantity for actual production? What is the fixed overheads? Normally, it is calculated. per direct what? It's normally calculated per direct labor hours. Yeah?
Mm,
Okay, fine.
yeah.
So when I am talking about capacity variance, I'm actually talking about the volume variance. It is the standard hours minus actual hours into OAR, or I would say into the standard fixed overhead absorption rate. Okay? Hello.
Yes, miss.
So when I am talking about the capacity variance, it is the same as calculating the fixed overhead volume variance. So it is standard hours for not budgeted production, standard hours, yeah, not actual production, but here you're going to take the budgeted production minus the actual
Okay.
hours for actual production into standard fixed
Mm,
overhead rate. Remember, when I am doing this standard quantity for actual production minus actual quantity for actual production, I'm finding fixed
mm.
overhead volume variance.
Miss, volume and capacity is the same thing?
No, in volume variance, I take standard quantity for actual production.
Okay.
What is the other fixed overhead variance?
Expenditure.
So the next variance is fixed overhead expenditure variance. In the expenditure variance, what do I do?
You take master budget minus actual budget?
Okay, so you take fixed overheads as per master budget.
Yeah. Minus fixed overheads as per
You
actual
take
budget.
fixed overheads as per master budget minus fixed overheads as per actual budget.
Mm,
Okay, but when you're doing the capacity variance, which variance you're doing?
capacity.
So in that you will take your labor hours as per master budget. You will take your labor hours as per master budget minus the labor hours as per actual budget into OAR. So in the capacity variance, you do standard hours for budgeted production minus the actual hours for actual production into the standard OAR. Which OAR? Into the standard overhead
Standard.
absorption rate. Please write it, I'll wait for you. So the capacity variance is actually telling us that if you have 10 laborers, okay? If, for example, you have 10 laborers and every laborer is going to work for 8 hours, so they should actually work
Mm,
for 80 hours. This we do it as per the budgeted production. We
okay.
hire our employees keeping our budgets in mind. Then we have our actual production happening. But when we are trying to find out the capacity variance, we are actually trying to see whether our laborers worked within our capacity or beyond our capacity. Whether they worked less than 80 hours or they worked more than 80 hours.
Okay.
So this is standard hours for expected budgeted production. Standard hours, standard production. So in the capacity variance, you take the variance between standard, the fixed budget, the standard hours for budgeted production minus actual hours work, so that you know that whether we worked beyond the capacity or we worked more than our capacity. So the capacity variance is basically going to tell us whether I have worked as per the budgeted capacity, I have worked more
Mm,
than the budgeted capacity, or I have worked less than the budgeted capacity. If I work more than the budgeted capacity, then I would have a favorable capacity variance. Just like the expenditure variance, even in the capacity variance, we are going to compare the master with the actual. What are you going to compare?
Okay.
The
The
master
master with the
with the actual. So here you'll use standard hours for standard production, and here you have actual hours for actual production. You will take the difference between it, and then you will multiply with your standard OAR.
Okay.
Okay, so
Hmm.
standard production is basically the budgeted production. So it tells us, it helps the management to assess whether you're using your resources as in the labor time, efficiently in terms of capacity or not. So here they are asking us to prepare a flexible budget statement. Okay, what are they asking us to prepare?
Flexible budget statement.
Flexible budget statement for the month of August.
Hmm.
Flexible budget statement means standard rate into actual quantity, and they have actually given us our actual budget statement. Yeah,
Yeah.
they have given us the actual budget statement and they have given us the variances.
Hmm.
If we plus or minus the variances, we can come on the flex. Let's take it one by one. Okay.
Okay.
I have sales that is 239,400. That is my actual sales. Yes.
Yeah.
Okay, fine. Flex this standard rate into actual quantity. Even this
Into
is for
actual
actual
quantity.
quantity. Even this is for actual quantity. So the variances are only going to be different because of the
Hmm.
rates. I hope you are with me.
Okay.
Okay. So even
Yeah.
this was for 1800 units. And even this is for 1800 units. So our
And
variance is going to be because of sales. And they say the sales price variance is 5,400 favorable.
hmm.
They say that the sales price variance is 5,400 favorable. When they say this
Okay.
is favorable, that means what I expected, I sold more.
Yeah.
So my expectation was 5,400 less, but I sold more. So as
Okay.
per flexed, my sales would have been 239,400, 239,400 minus 5,400.
Hmm.
Yeah.
Yeah.
So as per flexed, my actual sales would have been 234,000.
230. Okay.
Hmm?
Yeah. Yeah.
So we have done with the sales.
Yeah. Then direct material.
Now let's go to the direct material. Come on, material. So what is our direct actual material? 44,640.
Yeah.
Okay. I have an adverse variance. That means what? I
That.
expected to spend less.
But I spent more.
I expected to spend less,
But I spent more.
but you spent more. How much more did you spend?
1440.
1440 more you spent. So if you want to go on that less part which you had expected to sell, what will you do?
Hmm.
What will you do?
Minus it.
Minus what?
1440.
Minus 1440.
But miss, you also have the standard rate and actual quantity, right?
Sorry?
But we also have the standard rate and actual
Listen
quantity.
to, listen to me. We are given totals, right?
Yeah,
We are given the variances whether it is favorable or adverse.
okay.
Both are for actual quantity.
Hmm.
I want to make a flexible budget statement. A budget statement is actually the cost, the total. Rate into quantity, the total. So here I am not looking at individual variances. I am just saying how much is the variance. Variance analysis is an analysis between your flex budget and the actual budget.
Hmm. Okay.
Okay. So here I am trying to analyze what is the difference.
Hmm.
Are you with me?
Yeah.
Let's go to direct labor. You expected to spend this much,
Okay.
and the variance is favorable. You actually spent this much on labor, and the
Hmm.
variance is favorable.
So you spent less
You spent less. That means you expected to spend more.
and you spent less than
What will
expected.
you do? Your expectation was more to spend. What will you do? Come on, tell me. You
You
add
add
or
it, right?
subtract? You'll add
You
it.
add.
Okay.
So 108,000.
So it is 108,000. This was your expectation.
Okay.
Fixed overheads. What is the fixed
84.
overhead expenditure variance?
It's adverse 4,000.
So this is a difference between what?
Difference between master budget and actual budget.
Difference between master budget and actual budget. Capacity variance.
Capacity is adverse 11,600.
Difference between what?
Difference between standard labor hours and actual labor hours.
Master and actual.
Yeah.
And efficiency is what?
Efficiency is favorable 3,600. And
Okay. Now tell me, what is fixed overheads?
fixed overheads are the factory overheads.
Factory overheads that remains fixed irrespective of the production.
Yeah.
Okay. They are the overheads that remain fixed irrespective of the production. So come on, tell me, if I am going to add and subtract the minus, the adverse and favorable from the actuals, what will I do for the adverse and what will I do for the favorable?
Hmm. You'll minus the adverse and you'll add the favorable.
Yes, sir, you will minus the adverse. You'll minus the adverse or you'll add the adverse because you've done more expenditure.
You minus, right?
Flex was more.
Yeah.
Yeah, you will.
Oh, okay.
Yeah. You will minus the adverse and you will add the favorable. So your fixed overheads would be 84,000 minus
Okay,
4,000
so
minus 11,600
minus 11,000
plus
plus 16,
3,600.
72,000.
Yeah, 72,000. Okay.
Yeah.
So what is the profit that you're getting?
Let me 10,800.
10,800. So this is the profit that you're getting. Now this is your flexible budget statement. I hope you're with me.
Yeah.
Okay. There is another way to arrive at this also. Flexible budget statement. What is a flex budget statement?
Flexed budget statement is
Standard rate
times actual quantity.
times actual quantity. What is your actual quantity?
1,800.
1800. Now let's check for the direct material.
Okay.
24 is the material cost standard rate.
So 24 times 1,800 is 43,200.
Okay. Direct labor.
Times 60 is 108,000.
Okay. Fixed overheads.
Times 40 is 72,000.
Okay. I hope you're with me. So there are two ways you arrive from the variances or you do from this. If the variances are given from actual, you can go to the flex. How can you go to the flex?
If variants
Think
are
and tell
given,
me. 1 minute wait.
then you would
So if the variances are given from actual to flex, if you want to go, what will you
from
do?
actual you minus the adverse variances and add the favorable ones.
So you remove the adverse and add the favorable. This is
So
for
then
what?
for actual
This
to
is for
flex.
expenses.
Okay. And then for
For
sales.
income, you will do the opposite.
Okay.
Okay.
But if it's to actual,
From actual to flexed.
yeah.
But if from flex to actual you have to go, then you will do vice versa.
Okay.
Okay. So we are done with preparing the budgeted statement, flexible budget statement. Now they've asked us to prepare a statement reconciling the flexible budget profit with what?
The
Actual
actual profit.
So what is our actual profit? 4740. What is our flexible budget profit? 10,800.
Hmm.
Can you tell me how do we reconcile?
So first we do sales variance,
Okay.
price variance.
We first write our flexible budget profit and the actual profit.
Okay, yeah.
Okay. We first write our flexible budget profit and actual profit. So if you see our flexible budget profit is how much? 10,800.
10,000.
And actual profit is how much? 4740.
Yeah.
So you have to arrive from the flexible budget profit to the actual profit.
Okay.
Okay. The reasons for the difference is the variances.
Hmm.
Okay. You had 5,400 sales price variance, you had direct material variance, you had direct labor variance, and you had fixed overhead variance.
Hmm.
Your total fixed overhead variance was 12,000 adverse.
Okay.
Okay. Now tell me what will you add and subtract. I'll give you a minute's time. Think and then tell me. So this is reducing.
Yeah.
From flex to actually profit is reducing.
Okay.
So any favorable variance would increase your profit
Yeah.
because you either earned more or you spent less.
Hmm.
And any adverse variance is going to decrease your profit.
Yeah.
Okay. So in 10,800, all the favorables you will add. So
So sales.
10,800 plus 5,400
Hmm.
plus 1980. These are your favorables. So your total favorable is how much?
My total is
18,180. And your adverse you will subtract. So adverse is 13,440. So 4740. The reason why there is a difference between your flexible budget profit and your actual profit is these variances.
Okay.
Okay, a reconciliation statement is just a statement that tells us the reasons why there is a difference between the two figures that you are finding out. Do this.
Okay.
Try the E1. If you're watching the video,
Mm,
pause, look at the figures, try the E. If you still don't understand, then go to the explanation. You know your direct labor total variance is 1980 favorable.
yeah.
Are you with me? 1980 favorable. And they have told us that the actual labor rate per hour is 1550 per hour.
Mm,
They want us to explain the reasons for this favorable 1980 variance.
okay.
Okay, I have a 1980 favorable variance. I know that the direct labor total variance is made up of direct labor efficiency variance and direct labor price variance.
Yeah.
Okay, so what is the direct formula for direct labor efficiency variance? It's standard
Standard rate
quantity,
minus
actual
minus
quantity, standard quantity minus actual quantity,
times standard rate.
times standard rate, and this would be what?
Standard rate minus actual rate times actual quantity.
Times actual quantity. So I need to know my rate per hour. I need to know the actual quantity that I have used. These are the only things that I need to know. Am I correct?
Yeah. Hmm.
Fine. So these are the only things that I need to know. So I will go ahead to find out my standard quantity, my actual quantity that I have used. I know my actual direct labor cost is how much?
Is 106,020.
Okay, and I know the number of units that I have produced. It's how many units I have produced?
1,800.
You have produced 1,800 units. So, what would be the amount that I have paid per unit?
58.90.
58.9 I have paid per unit. Okay, so I know my actual hour, the money that I have paid per hour is how much? 15.50.
Uh,
Given in the
Yeah,
question, labor rate per hour.
is 15.50. Yeah.
So I know 15.50 per hour multiplied by how many actual number of hours they have taken. I would have got the actual rate of 58.9.
Yeah.
So actual rate per hour, actual number of hours per unit I would get is 3.8 per hour per unit.
Okay.
3.8 hours per unit.
Hmm.
Yeah.
Yeah.
So my standard hours per unit was 4.
Yeah. And
My
my actual is
actual
3.
hours per unit is 3.8. My
Okay.
standard rate, labor rate per hour is 15. My
Hmm.
actual labor rate per hour is how much?
15.
15.50. That means I am paying my laborers more.
So adverse.
I'm paying my laborers more, but they are using less number of hours to make the number of units.
Oh,
Yeah.
okay. Yeah.
I'm paying the laborers more, and the hours that they are using per unit is less, that is 0.2.
Hmm.
So I am going to find out the direct labor efficiency variance. Come on, give me the formula for efficiency variance.
Standard rate times standard quantity minus actual quantity.
Standard quantity minus actual quantity. So it would be 4 minus 3.8. So this would become how much? 0.2.
Yeah, times 15. So that's
Standard
3.
rate.
Yeah, so that's 3.
0.2 into
Times 15.
15. So it is 3.
So 5,000.
3 into 1800 units for actual quantity produced. So I have 5,400 favorable.
Okay, yeah.
So the efficiency variances, they are taking less time to produce the units. So my efficiency variance is favorable. This will give me my efficiency variance.
Okay.
Now rate variance. Rate
Rate
variance is
is
going to be favorable or adverse?
adverse because it's more than expected.
It's more than expected. How much adverse?
0.5 multiplied by 3.8. That's
Into
1.9.
actual rate or standard rate? No, into actual quantity.
Actual quantity, so 3.8
So
is 1.9
0.5 into 3.8, 1.9 into
times
1800.
100. 3420.
So it is 3420. Adverse or favorable?
Adverse.
Adverse. So this is going to give us a total favorable of 1980. Yes?
Yeah.
Okay. So this is going to give us a total favorable of 1980. Now I will go back to our question and see what are they asking us.
Okay.
Explain the reasons for the favorable or adverse variance.
So the rate is
Problems to
adverse.
analysis. So rate variance is 3420 adverse,
And
and you will give
efficiency.
you will find out how did you get the rate.
Okay.
You will give this working.
Okay.
So the laborers are charging higher rates per hour than expected, leading to an adverse variable. Yeah,
Yeah.
possibly this is due to more skilled or trained workers that we have employed.
Yeah.
Okay, this is directly showing us that even though we are paying them a higher rate, the efficiency has increased, giving us a favorable efficiency variance, leading to a total labor variance to be favorable. Why? Because the workers took fewer hours than expected to produce because of the better quality and because of their better skill. This will give you 4 marks. You have to show your working, and even if you just mention and one reason you give, you will get the marks.
Okay.
Okay. Now the F part. You've done the F part.
Yeah.
Can you read the question for the F part for me?
The directors are aware of a upward trend in the direct material price. To keep the current profit level, they have 2 options. Option 1, modify the existing product so that it requires less direct material. And option
Okay.
2, reduce advertising cost.
Okay. We
So,
want the current profit level.
yeah.
And the price of the material is rising.
Mm.
So what they should do?
Option one,
If first give me the bifurcation, it's 7 marks. So you will give 3 points for option one, 3 points for option two. Advantages, disadvantages together. 1 mark
mm,
for advice.
okay.
For option one, tell me.
Advantages are that because it's a new product, they can appeal to like newer customers, and they can save the direct material cost because it's a new product that requires less direct material.
So they have
And
to
disadvantage.
modify the product. The option one is you're going to modify the product so
Oh
that
yeah,
it requires less material.
yeah, but because they're modifying it and they're using less direct material, the quality might be bad. So customers might not like it. Like the existing customers might
And the
not like
current
it.
profit would still remain the same if you modify it.
Hmm.
If you reduce the advertisement cost,
Then, if you reduce it, then uh, the
but existing customers will remain. They will not go away.
main,
But
but
you may
because they
not get
reduce,
new customers.
yeah, there's a less loss of new customers.
And maybe your profits can reduce if you do not keep on advertising because your current customers may switch to the different people.
Yeah.
Okay. If I
Hmm.
do not do advertisement cost, I cannot increase the selling price because awareness about my product will be in less reach.
Hmm.
So what they should do,
They
they
should go with.
can reduce the advertisement cost if they have enough number of customers.
Okay.
Okay, so with this we
Hmm.
complete our October November 24 paper 42 question number 1, and it's just a little bit of formulas ups and downs that you have to apply. It is nothing more in it, but your concepts need to be cleared.